We have a really exciting guest with us. So this session is our VC panel. We have had 9 Atrium Scales, and this is the first time we're doing a VC panel, so we're super excited about it. So we'll just dive right in. I will quickly, go. We have Dan Levine here from Accel, and he's a partner at Accel. We have Rick Yang, a partner at NEA, Connie Chan from Andreessen Horowitz as a general partner, and Sarah Tavel, Benchmark general partner. So really high caliber VC folks here, and I'm going to just dive right in and let each of them introduce themselves.
I'll start it off. I'm Dan. I'm at Accel. We do everything most of these folks do on the investing side, so we're looking at kind of core technology stuff, less biotech, less clean tech, less healthcare for us, but all the core stuff you know and love. We do it in the US, India, throughout Europe, and kind of globally. And we actually have an early stage fund and also a growth fund, but we'll probably going to be talking about the early stage fund here. And then personally, I like to invest in products that people like to use in areas where that matters. So that'll be consumer, kind of bottoms up B2B, like a Dropbox or Slack, and then high leverage individuals like developer infrastructure, APIs, things like that.
So I'm Rick Yang, partner at NEA. I've been at NEA now for about a dozen years. We're similar. I would say the one thing that makes us a little bit different is we do everything out of a single fund. So we're investing out of a $3+ billion fund across tech and healthcare, all stages, all sectors, all geographies. I personally spend most of my time in the consumer and fintech sectors and have invested in companies like Masterclass and Opendoor and Plaid and various companies like that.
Cool. My name is Connie. We invest also across all kinds of software companies, enterprise, consumer, bio, crypto even. I guess one thing that's unique about my investment philosophy, I spend a lot of time studying companies in Asia. And so a lot of my inspiration for where I think product market fit can occur comes from my studying of what's happening in Southeast Asia or in China in particular. I look at all kinds of consumer deals, and consumer for us means anything non-enterprise. Basically, most things that don't have a sales team will count as consumer. And I like to look at seeds and A's in particular. Sectors of interest, anything social. I actually still believe social is investable, which is kind of rare. Anything video, audio, ed tech I like. Real estate is another big area that I like.
Hi, everybody. My name is Sarah. I feel, Benchmark, we do one thing, which is early stage investing. So kind of Series A's are what we wake up to do every morning. When we really mess up and miss the A, we'll do the B, but that's like really what it's about. Software, consumer, infrastructure, kind of just anything up and down the stack. Our fund is about $425 million, I think it's the number, which has been what it's been from the beginning, which means that we don't go after things that are capital intensive. So not CapEx, not hardware, not bio. I personally spend a lot of time looking at consumers, so marketplaces, transactional businesses, social, stuff higher up in the stack on the B2B side, so anything that makes an employee more effective, happier, more engaged in what they do, more productive. And, but basically the way we work is because we're this small equal partnership. If you ever have a company you want to introduce to a Benchmark partner, you can just funnel it to me. I'm Sarah at Benchmark, and I would distribute it to the right person at the firm.
Thank you. So a lot of our founders in the room here are, gearing up to raise their next round. What are 2 to 3 of the characteristics or things that you look for in a founder in their pitch?
Want me to start? I think that what really makes me lean in on a company is when there's a founder who describes a future that I just never would have thought about before and helps you feel like it will be the future and has a path to get there. And I think one of the things that I really believe is that being a founder is like an affliction in a way. You don't just say oh, I'm a Google PM and now I want to start a company because it's the next rung on the ladder. It's something where you're just obsessed with that idea. You wake up every day to do it, and you have the grit and determination to push through.
Yeah, we talk a lot about founders that have a secret, an earned secret, whether it's through previous careers or some different way of thinking about the world that most people would disagree with. And those are the kinds of companies that we like.
Yeah, just to kind of add on to that, I think complementing that almost obsession with the problem space and what you're doing and what you're building from a company perspective, one of the things that we look for is what I call capacity, right? And just founders with very high capacity. And when we're talking about early stage companies, as a founder or as a founding team, having thought about every single aspect of your business and recognizing the areas that you haven't thought about and taking a genuine interest in learning about those aspects of the business, I think is really important because when we invest in a company, we really think about how it scales over time. And I think you have to start with that baseline of capacity to be able to scale with the company and really approach a lot of the challenges that you'll see along the way.
Sure, I always tell people, I mean, we try to invest as early as we possibly can. So seed, A, hundreds of thousands of dollars, whatever it needs to be. And when we're looking at a company at that stage, I always say we look at 2.5 things, and this is a little bit unique to me. The first thing is kind of the team. And the number one thing for me is, do I like this person? And the reason is, I'm gonna have to tell people that they should spend their lives working with you, working for you. And if I don't like somebody, I don't care if they're gonna make a lot of money for somebody. It's just gonna be so hard for me to go to work for them every day. So the number one thing is, do I like you? Unfortunately. The second thing is, do you have high horsepower? Are you really sharp? Are you willing to work really hard? And then the last thing that I think is super important, so the most important thing after the first one is, can you multiply, which is, can you attract other people? Ultimately, like in any given time, we're investing in a group of people and kind of a direction. It's almost like a vector in the mathematical sense. And that team is what matters. You know, almost all of our companies, like, will go through changes and pivots and things like that, and the team is the most important piece. The second one of the 2.5 is market, and I roughly look at that in 2 ways. The first is this thing big enough? I'm open-minded about most things, but I think cupcakes are awesome. I eat far too many of them, but it's probably harder for us to invest in a physical cupcake maker. The second part, so the market has to be huge, and the second part is, do you have kind of an interesting insertion? I think if you can get something that people love and a product that people like to use, that really has a lot of legs. I think it'd be hard-pressed for anyone to say that, you know, sharing air mattresses on somebody's floor would have been the start of Airbnb, but it really was. I mean, it legitimately was for people who weren't around when that actually happened. That was how they got started. And then the half.
That's like an earned secret, right? Like, that's something that's counterintuitive.
Yeah, I think so. Well, I don't know if Brian and Joe would think that as an earned secret, but maybe yes. And then the half piece is the other stuff, which is like, you know, given you've been working at it with this team for this period of time, what have you accomplished? It's a lot less important. One of the weird tricks of our business is, you know, we invest and buy equity over a long period of time, and eventually it has to get liquid for us to make money, right? So that's an important component. But, you know, honestly, being at $1 million of ARR is relatively inconsequential statistically towards the likelihood you're going to 100 million, right? You hear about the successes, and every company that's at 100 has once been at 1. But there are so many companies at $1 million of ARR that won't make it to 100 million or 200 or 300 million or whatever it is. And so all of those things are kind of trailing indicators of team and market that we look at only because I might love somebody and they might be in a great market, but if you've been working at it with $100 million for 10 years and it just hasn't gone that well, I might be missing a little something, and why you haven't gotten a little more progress.
I think just to get a little bit more specific too, in terms of my bias is largely a consumer investor, and we're actually seeing this a lot more with my enterprise partners too, is one thing we actually look for is something that we think of as taste. And this has to do with design, it has to do with storytelling, it has to do with just, in some ways, kind of that secret of like, you kind of know it when you see it, and a lot of these founders that have taste that are going after consumer markets, and that consumer can be a pure consumer, or it could be a consumer that's sitting down at their desk getting ready to work and opening up Slack, for example. But just knowing what is going to resonate with the consumer when it comes to that experience to get them to use your product and to really resonate with that product. And I think that's something that we've really seen take shape over the past 5 or 6 years across a bunch of different sectors. And I think, you know, we've come to think of it as taste, and it's really hard to explain. But it's something that a lot of our really thoughtful founders are thinking about right now.
It means they care about user experience, and it's not just the business model behind it.
So earned secret, taste, and getting founders, you liking the founders, those are all seemingly really subjective, right? So what's the biggest piece of advice, I guess, that you would give first-time founders when they're coming to pitch to you to get that across?
I mean, when I was a really little kid, I liked to lie a lot. I don't know why. I think I figured out at like 7 years old that I could say something that wasn't true.
I like where this is going.
And then you can get away with it. And this is, to a 7-year-old, this is magical. For those of you who have kids, that I'm sure they're like, oh my God, I didn't have to answer the honest thing, and I seem like I've gotten away with it. But what you realize over time, I think, in your life is it's extremely hard to keep track of that, right? The problem with lies is they're like hard to come up with because they aren't real. I'm particularly biased towards, I love to read nonfiction. I've always thought like the story of Alexander and Hamilton, for instance, is stranger than fiction in many ways and just an incredible story. So I think the most important thing for founders is just be genuine, because it's easier, and that will tell. Like, I'll be able to better tell, do I like this person? Can we work well together? I think a lot of times people think about the investing process as zero sum, which is kind of categorically not what it is, right? I mean, I'm buying equity in you over time in your company. So you really want like a good match. Like, you should try and get to know me as well as you can and the firm and what we can do, and vice versa. I want to get to know you for who you are. And sometimes they're great companies and we're not a match, and that's okay. And there's lots of great companies in the world, and hopefully you'll go on and do something awesome, and I'll go invest in other things and we'll be okay. But you have to be genuine, otherwise it's so hard to filter through everything. And so if I sense that there's like a lack of somebody being genuine, that's almost an immediate signal that I probably can't work with this person, because how can I trust anything else that's going on in the room? And then from being genuine, that's kind of the most important thing, and then hopefully the team and the market speaks for itself.
And what I would add is, I find that when people come in to pitch, they think it's all about convincing the investor that you should invest in the company. But I think the first order of operations for you is to really be like authentic with yourself and make sure you're convincing yourself first that this is a company that's worth raising money for. Because it's so easy to be playing this game of projecting what you think VCs want and then trying to solve for that. And it ends up being just like a kind of a house of mirrors to like what the real core of the company is. So I say, like, number one, just like convince yourself first that this is the thing you want to spend the next 10 years of your life on. Don't think about convincing the investors. And the second thing is, like, you think it's like, kind of like people think negotiating is like this zero-sum game, but really when you approach it right, it's about collaborating on a deal. And I think very much the same thing when you're doing a pitch is, like, if you're trying to sell your company, then it comes through as that transparency comes through. And really what a pitch is about building a relationship with someone so that they're going to spend their time with you building the company. And the last thing you want is to like sell, and then you have that first board meeting and you sold something that's over here when the reality of the company or the things that you're really thinking about or the fears that you have are over there. And then you can't really build a great relationship starting out that way.
My advice for fundraising is treat the whole task of fundraising like a big project. Like, do your research on it. Going to an event like this is great to start, but when you're trying to make your list of all the VCs you want to talk to, figure out which GP at the firm might be the best fit. Or in Sarah's case, just send it to Sarah, Sarah at benchmark.com. But most of the time you want to figure out which GP you want to target. And in some cases you want to figure out, do you want to use LinkedIn to reach out to them? Can you start building a relationship on Twitter? Can you start replying to their tweets, right? Check, do they have already investments in conflicting companies? Or if they're already invested in your competitor, they probably don't seem like a good match for you. And not every VC is going to tell you before the pitch if they've already invested in your competitor. So treat the act of fundraising like a homework assignment. Have a spreadsheet, list out all of the VCs, the GPs, any notes, any conflicting companies they've invested in, and then prep all of your data. Because people are going to ask very standard diligence questions. If you're a consumer app, they're going to ask about cohorts, engagement. All companies are going to need org charts, cap tables, and so forth. So have all that data ready to go, especially because once you start talking to VCs, if you're lucky, it can move really, really fast. And these diligence questions are going to come in. Yeah. And if you don't give us an answer back within a few days, it can spook the VC that you don't have that data ready available.
I want to say something that may or may not be controversial, but I really process investment decks really well and company overview decks really well. And so, you have kind of a 50-50 if you survey a room of whether people like to get a really polished up deck or not. I personally do, and I'm able to kind of synthesize and digest information a lot better that way in sort of a first meeting. So I would encourage folks to really be thoughtful about putting together a deck, even though it is a lot more about building that relationship and getting to know each other. I think in many ways, we also want to be able to see how you think about your business, how you present it, how you would present it not only to customers and employees, but also future investors or other investors in that syndicate. So, I am certainly squarely in the camp of being very, very well prepared and actually over preparing and spending a lot of time on a deck. Some people will tell you the exact opposite advice. And so part of kind of Connie's advice of like getting to know the investor is also figuring out, do they like things like that? How do they operate? Talking to other entrepreneurs that have pitched that firm or our portfolio companies. And the other advice I give that's less about delivering information and delivering the pitch is I will always take an introduction from one of my existing portfolio companies, no matter what the company is, no matter what the stage is. And I'll be very upfront and transparent about, hey, I think this is a fit or not, but like because it's coming from one of my existing portfolio companies, I'm happy to take the meeting no matter what. So figuring out some of these little things, and they will vary by investors, will really kind of save you a lot of time and make you much more productive and efficient. Because I do think that fundraising is a full-time job, and in many cases it's going to be very distracting from the everyday business, and so you have to treat it that way, because I think if you're halfway in and halfway out, both sides are going to suffer, both the operations of the business, and it's going to take you longer to fundraise. So I would treat it as sort of not only just a big project, but like the project.
One other thing I'd add is remember, fundraising is, again, it's two people coming together, it's two sides coming together, it's us as investors and you all as operators and people starting a company, which is awesome. So two things on that as a quick note. One is like, do get to know the investors. Like you want to know who you're getting married to a certain extent over time, who you're going to spend a decade with. The other thing I would say, and this is not for anyone on the panel, but recognizing other investors, like one of the challenges is, I think many times, and events like this are kind of certainly an example, many times there's a asymmetry of information around the market. And so one thing that happens a lot, back when I was a founder and when I talked to a lot of my friends who are starting companies, they want to know more about how the process works or what makes sense or what kind of qualifications to raise money. And so on the one hand, as investors, I think we always need to do a better job trying to be helpful to people starting companies and thinking about raising money and providing more transparency. On the other hand, a lot of that transparency we want to provide, but it's a lot of bespoke stuff. I think you've heard us all say different things about what we look for in investment. And so one thing I'm always wary of is, when investors expound upon explicit things, particularly financial metrics or goals, that if you hit that, then they're interested. I don't think that's basically how the best investments are made. And I think oftentimes those folks are engaging in marketing, right? So just like, I think it's disingenuous, be genuine as a founder when you're raising money. I wish investors often were more genuine about what they actually look for. And even though it's complex sometimes, that's something you kind of have to go through. And so do be a little bit wary. Oftentimes there's definitely been an ongoing trend over the last couple of years of people, they send me a note about grabbing coffee, and then we grab coffee, and they're like, we're thinking about raising money. Oh, and by the way, in about a month, we're going to hit $1 million of ARR, or something like that. Now they're thinking about raising a Series A. And I don't know how this got started. It's like the least important thing I've ever seen. I mean, $1 million of ARR, like at this point, when people show me a slide that says $1 million in ARR, I'm probably slightly discounting my interest level. I'm just kind of like, they've read some blog post somewhere that was probably maybe well-intentioned or maybe marketing, but doesn't reflect those 2.5 things that I look for, what we really care about, which is, are you great? Is the founder great? Is the market great? Can this be a huge company? And do we want to work with you and help build it? And so I understand why some people do it, why some people do marketing on our side, but it concerns me, and too often I think founders by the hook, like consider. For the best example of marketing, I think in our industry, maybe Sarah's website is phenomenal, and I think you should all check it.
Thank you for that endorsement.
Great. So we've talked about some of the things that you all look for in founders when they're fundraising. What about some common mistakes or blunders that founders make? 1 million ARR on a slide might be one of them, but what else is there?
Yeah, I would say, NEA itself is a fairly large firm for the venture industry. Thinking that the partners don't talk to each other within the firm, I think is one of the things that is probably the most frustrating on our end, because it is actually a very collaborative partnership, and most venture firms are. And we're talking to each other a lot throughout the week. And having a conversation with one partner and having it, figuring out that it's not a fit for one reason or another on either side, and then cold reaching out to another without really even mentioning it, I think is always a frustrating thing to happen.
I think during the pitch, especially in early stage seed or Series A companies, If they paint anything about like acquisition, like I can get acquired probably for $50 million, or these are the people who are already talking to us getting acquired, or if the VC senses anything around this person is going to sell out within like a year or two, that is also a turnoff, because if we're going to give up a board seat and spend a lot of time with this company, we're hoping that this can be a home run. We're not looking to go just to one base and get a good return, but actual dollars not move the fund. So making sure people don't send signals early on that they would sell out early.
What about the signals afterwards? Let's say you've made an investment. There are a lot of founders here that are wondering how often to update their board and what level of information to provide. What tends to be your preference?
I think a lot of it is just building a relationship and what makes sense for the company and the stage and what's happening. I think certainly when we're engaged in like some kind of executive hiring thing, I'll probably be talking to the founder more often, or if something's going wrong, I want to be there for the founder. I think the big mistakes that people make, and even when I invest in seed stage companies, we might not have a board. And I cribbed this from Y Combinator actually. I think, I don't know, PG's probably not here, and I always, the only thing I require of my seed investments with no board structure or anything like that is you have to spend 1 hour a month with me, but you can talk about literally whatever you want. It doesn't matter. We can talk about the weather for an hour. And the reason is that what are the fail cases or what can go wrong? So if everything's going great and you talk to me for an hour, that's awesome. And I'm happy to do it, and it's a great use of my time, and I'm happy to figure out how I can help more. If everything's going great and we don't talk, you're probably okay, no big deal. If everything's going badly and we talk, then maybe I can be helpful. And a lot of help is sometimes, you guys all know how hard this job is, right? I was a terrible founder once, just awful. And it was so tricky, and I was like losing hair and had back pain. It was really awful. And I didn't have a lot of hair then to lose. It was different losing of hair. But, it's really hard. And so a lot of what the job is at that early stage is just to say, you'll be okay. You'll make it through. Like, this day's been hard, this week has been hard. There'll be another week, let's just figure it out. But the failure case that I'm watching out for at the early stage is something's going wrong, and we don't have a regular scheduled conversation. And I think the PG quote was, "You just go die in a corner," which is a little bit more blunt than I would put. But you're just so, it's hard as a founder. You've all probably experienced this. Maybe your friends and family have given you money. Maybe you've hired people, and they have lives and they need the salary, and all of a sudden you feel like this is it. It's over. And not the easy thing to do, the one thing to do that happens is it gets lonely, and it's hard to talk to people about it. And I think one of the most important things that we do is we tell you it's going to be okay, and it really is. Like, we've seen it a lot, and like, we backed you for a reason, and it's going to be all right, and hopefully the company will come back, and that's most of the time that's the case, and sometimes we'll have to work through something. But the worst thing you can do at that moment is be alone. This is true, by the way, of your lives generally, I think. So be communicative in the bad scenarios, and then broadly speaking, like, it shouldn't be a burden. It should just be something where you want to keep us informed. I'd also say don't surprise us. That's usually a bad sign. Like, when you have a board and you've raised like $10 million or whatever it is, like, you generally want to do less on surprise. So try and give people a quick heads up as to what's going on, and even if you have to surprise us, we'll be fine. We're professionals. But.
Yeah, I think the beauty of the time we're in now is like there's varying levels of engagement and communication where it's easy to send a quick text. It's easy to send an email. You can get on a Zoom. You can meet in person. There's kind of this whole range of things you can do.
Startup idea, notification overload. No, I'm just kidding.
And it's, for the most part, like, knowing the other panelists up here, like, we're all very accessible, right? I think one of the things that I'm very sensitive to as an investor and a board member in a company is spending too much time and asking for too much time from our founders, because most of them at the early stages have a lot of shit to do, right? And so I will tell you, like, the most regular mode of engagement that I have with most of my companies at the Series A or Series B stage is we just kind of set an hour aside every 2 or 3 weeks, and either side can cancel for any given reason, and we can talk about whatever you want in that time. And if most of the time, those conversations actually last for like 15 minutes, and then you have 45 minutes that has been set aside in your calendar to catch up on stuff and do whatever you want. But that's just kind of my mode of interaction, and I would say that half of my portfolio companies I interact with that way, and half of them we do something different. And it really just kind of depends on what the company needs. And for the most part, any given company is dealing with something that either needs more attention or less. And so it's really more of just like a pull model than a hey, we have to catch up on these 5 things every 6 weeks, and I need to know what's happening. Most companies are just not run that way, and there's plenty of other stuff for you guys to be doing anyways.
I agree. I think a lot of us will do scheduled time with our founders. One thing I wanted to say is, though, you also want to update not just the investor who you picked for your Series A, but a lot of the ones that you didn't pick who have a shot of doing your Series B. And it's important to kind of keep those relationships going, because this way when you pop up for your Series B or Series C, you've already kind of given them some updates throughout. And actually now a lot of firms are preempting rounds. So you might even get a preemptive term sheet from giving those updates and sharing them. Of course, you don't go in the same amount of detail as you would give a board member, but a lot of companies that I pass on will still send me emails and give me lots of updates on how they're doing and still ask for coffee regularly.
I mean, the only thing I'll add is, the way the question was framed is almost like it's a responsibility you have. And the way that I would think about the investor you bring on is, I think as a board member that you bring on is that they're an extension of your team. And so how would you think about, you hire someone on your team, what's the cadence to make that person productive for you and effective in what they do? It's the same thing with that board member you bring on. And so I personally love to spend some time up front. I kind of describe it as mind melding, where I want to understand, I want as much of a dump as possible on all the things that you're thinking about so that I can start thinking about them too. And then from there, we start to develop a cadence. It's weekly in the beginning, then it goes to every other week. And I have companies I've been working on for a few years now, and we're still every other week. But texting all the time, emailing all the time, if we're doing a search, doing calls, if it's an extension of your team. You'll have plenty of investors that did the seed investment that are more passive. I don't think you have any responsibility there. It's kind of a little bit, do you feel like you get value and leverage out of those people that you're giving an update to? Are they sending you candidates? Are they introducing you to customers? And if they are, put the energy in and get energy back. But if they're not, then that's a good answer.
I will tell you one of the other benefits of having regular time with one of your board members is it forces them, at least when I'm in my position, it forces me to, when I look at my calendar and see a session coming up one-on-one with one of my portfolio companies, to remember, oh, did I follow up on those 3 things from the previous session? And so it kind of forces me to have a checkpoint and really put that company top of mind for me.
Great. Yeah, the extension of your team, the partnership with investors has been a huge theme of the day with almost every single speaker, so I'm really glad to hear it. But in that vein, though, how should founders pick their investors? And how have the best founders used your skill sets to their advantage?
You want bad-looking investors to make yourself relatively look better. Sorry. How do you speak? I mean, I think that, again, the most important thing is the same criteria I use in reverse, which is hopefully, you build a great relationship with somebody, you like them, you trust them, which is really important, and then you think they can be helpful. I mean, this is a bit of an unfair thing, and to slightly market Accel incidentally, but when I came back to Accel about 5 years ago from Dropbox, people ask me, why did you do it? Or why join Dropbox? And I thought what do I like to do? I like to help people start companies and help them build companies. That's the part I like. What don't I like about what my job is? I'm not so interested in the financial engineering mechanics of our job. It's not my background. It's not as much my interest, right? I'm more interested in actually the product, the software engineering, the company building pieces. And for all the stuff I was interested in, a place like Accel and a lot of the firms here can be an amplifier for that. And that's really fun. And a lot of what Accel did was give me a lot of unfair advantages. More and more companies go global, and we have a team in Europe and India that can be helpful, or companies are growing in later stage and they need more capital, and we can do that as well. And so those made things about my job easier. So I do think what you want most importantly is find somebody you can work with, find somebody you trust, find somebody you like, and then find somebody who can be helpful. And the way I always like to think about it is I always try and be as lazy as I can. I think there's some Bill Gates quote somewhere there, but I always try and be as lazy and stupid as I can, because I'm think to myself, I might be able to be smart and work hard, but you want to find a great opportunity and you want it to be easy, and then you need to be willing as necessary to be smart and work hard. And so when you think about your investor, you do want the same thing. This isn't usually where companies are won or lost exactly as oh, this is a perfect investor and this one's the worst. It tends to be a little bit more marginal, but as a founder, you want to pick the best one, because if it makes it any easier at all, that's great for you. So you guys are still doing all the work and the most important parts of the game and the team is, but if we can be just a little bit unfairly helping you, then that's great.
I think helpfulness is the key. Optimize for who is going to be most helpful, but help comes in many different ways. It can mean that they give you the best terms. It can mean that they have a lot of management experience and you really want to learn how to build a very large company. It can mean that they know insights about your product or about your sector that you don't, and they really add to your product thinking, especially for early stage companies. It can mean halo effect. It can mean a lot of different things. So it's really looking for where do you feel like you have personal deficits and finding someone who can complement you and help you in those areas.
Yeah, like I absolutely agree with that. Like the analogy I always make is, I feel like we expect less from the board members that you end up getting, like, than you should. Like I think kind of if you stopped dating before you got married, you would never know how great a marriage could be. And like a great marriage makes you the best part, like the best version of yourself. And I think that a great board member, a great partner for you at the Series A makes you the best version of yourself and therefore makes you like able to build the most, like the company that you really want to build. And that's like a combination of all the things that Connie described. And I would really keep that aspiration in your mind because I think it's so easy to reduce the person who's going to be on your board to money or control. And I've got to tell you, I've been on boards and I see the difference between someone who does make you the best version of yourself and the person who is either just there or actually is a distraction, has poor judgment, whatever it may be. And it is not about the vote. It's not about the valuation you got. It is about building a big company, and it makes a huge, huge difference at the A especially.
I think what I would say is you won't go wrong with any of our firms up here. I mean, these are all great firms in all different ways and can add value and accelerate things and do all sorts of things to help you scale a company. I would say over-reference. I mean, do as many references as you can on the firms that you're really serious about, and they will all provide references to you. And then there's so much data out there on who is invested in what that it's very easy to do all sorts of back-channel references. I mean, it's the same thing as hiring a really key employee, right? Just over-reference people. That's where you're going to get the best information, the best dirt, because at the end of the day, like we're all salespeople when it comes to a company that is a great fit that we want to invest in. So make sure you do lots and lots of references. And a lot of times when sometimes these financing processes are crazy and they're happening very quickly and there's a lot of people involved, take the time to really do references. I think that's going to be your number one source for information.
I'll add one thing. Don't call the high-profile company. That's not going to be a useful reference.
Right.
Call the ones that have gone sideways, have gone through a hard part, because that's when you find the difference between the fair weather VC and the real VC.
Thank you. So the last question from me before we open it up to the crowd. Pretty much everyone here has raised some amount of money. Should there be a difference in their approach or their narrative as they're raising follow-on rounds and larger rounds?
Did I ask in terms of like the pitch they make or?
Pitch they make, the narrative they have, their way they're approaching you. Should there be any difference?
Personally, I hope not. I mean, the thing I love to do is invest as early as I possibly can in a company. I think something like half of our investments are made in just the team and an idea, and that's seed and Series A. People don't believe us, but it's true. We look at this a lot. And one of the cool things at that is you don't get caught up in kind of the tactical details of like how it's going. Because it's not really going, which is nice. And so usually the best companies that we have, they tend to have kind of these simple, concise, almost pithy interpretations of what they're doing, why they're the best team to do it, and how it's going to be big. And one of the cool things is watching over time, those things continue to be the same. I do think like over time, as you get bigger and you're raising capital at later and later stages, you probably have to slowly add higher resolution to a certain extent. But at least for me, that's why I don't do as much of the later stage investing personally. So if you're looking to raise like 50 million, I'm less ideal for that. But I like when it's kind of low resolution. It's really about the team. It's about my relationship with them, and it's about some market. And we feel like we're kind of in it together, going after it. And it's one of the. For me personally, like I love to invest as early as possible. So the worst thing everyone's done in this room for me is you've already raised some capital. That's okay. Yeah, I think that's the most fun part. So for me personally, that's the answer.
I mean, what I say is that I think of it as a slider where it's vision and then the numbers. And the earlier you are, it's like 100% vision. And then the further you go towards like investing, like subsequent rounds, you end up pushing that dial more and more towards the numbers. And by the time you're a public company, like if you don't mention the vision, no one will care because it's all about the numbers. And so I just think that like, I mean, Dan to describe it as resolution, like it just have the expectation, know in your mind that as you progress in the financing rounds, it'll become more and more about the numbers.
And to that point, like if you're going out for a Series B and they're asking you about numbers, you need to know them. You have to have them ready to go.
Absolutely.
Your deck shouldn't just be text and photos. It has to have numbers in them as well.
Yes.
What about gifts?
And I also like, and what Connie mentioned is like being on top of it. Like, and you look at the A, I don't think you have to worry about it as much. But at the D, like, man, if you don't know your numbers, or if you have a highly quantitative product or very operational with like thin margins, like part of the, one thing we haven't talked about is founder kind of company fit, but like that is absolutely something that you have to be like on top of.
I mean, a big data point that we have as prospective investors for a company that has raised money is how have you used that money, right? And so make sure that you understand how you have used that money and understand, you know, what kind of relationship you have with your existing investors, because that's also a point of reference for us as new investors potentially coming in, is looking at that syndicate and asking them, hey, you know, what's it like working with these folks? And it's really important for us to make sure that there's a good fit on that front too.
I wanted to say a huge thank you to our panelists. Let's give them a huge round of applause.